Credit rating. The term credit rating refers to a quantified assessment of a borrower's credit worthiness, in general terms, or with respect to a particular debt or financial obligation. The global credit rating industry is highly concentrated, with 3 agencies controlling nearly the entire market. It's Moody's, S&P Global, and Fitch Rating. You can see a credit rating matrix in front of you. You can see that for all 3 credit rating agencies, AAA means extremely strong capacity to meet commitments. And then from here down, the rating goes down as well. And the last one would be C for Moody's, RD, D for S&P, and triple D and D for Fitch, meaning payment default on financial commitments. And all the variety of credit ratings in between. For example, Baa1 for Moody's, BBB plus for S&P, and BBB plus for Fitch would mean adequate capacity to meet financial commitments, but more subject to adverse economic conditions. If we are going into Caa1 for Moody's and CCC plus for S&P and Fitch, that would be currently vulnerable and dependent on favorable business, financial, and economic conditions to meet financial commitments, and so on and so forth. So you can see that the higher ratings from AAA to BBB minus would be an investment grade, which means high probability you will get interest and principal on time when you loan money to the borrower. And below BBB minus, it goes speculative credit ratings, meaning high risk, and very possibly you will not get interest and principal on time if you loan money to the borrower. You can hear such a terminology as fallen angel in financial world. Fallen angel is a bond that was initially given an investment grade rating but has since been reduced to junk bond status. The downgrade is caused by a deterioration in the financial condition of the issuer. On the contrary, Rising Star is a bond that is rated as a junk bond but could become investment grade because of improvements in the issuing company's credit quality. By investing during a security's temporary fallen angel status, investors can benefit from an opportunity to generate strong returns. By identifying a rising star bond at the right stage of the market cycle, investors can earn higher yields from a firm that is more likely to meet its financial obligations. When credit rating agencies are trying to evaluate credit ratings for the companies, they consider business and financial risk. Business risk refers to the company's ability to generate sufficient revenue to cover its operational expenses. To evaluate business risk, we would look into country risk, industry dynamics, company position, profitability, and peer group analysis. Financial risk refers to a company's ability to manage its debt and financial leverage. To evaluate the financial risk, we consider accounting policy of this company, financial policy and governance, cash flow adequacy, capital structure, and liquidity. We will talk more about business and financial risk separately in the following videos. Business and financial risk combined help the rating agencies to come up with an accurate credit rating for the industry and companies.